first component in the general deduction formula, if we start off with a positive test, is in the carrying on of a trade. So let's take a look exactly what is meant with trade. We find a definition for trade in Section 1 of the Income Tax Act. And if you look at this definition, it is very wide. It includes every profession, every trade, business, employment is specifically included as a trade, calling, occupation or venture, including the letting of any property, and the use or the grant of use or permission to use any patent, any design, any trademark, any copyright, or any other property that is of a similar nature. So you'll see that this definition is really, really wide, and this is also confirmed by the court case that is associated with trade, Burgess, because the Burgess principle said that the definition of trade should be given the widest possible interpretation, and it includes any profitable activity, even if it was a single activity. But be careful, not all activities constitute a trade. There are certain activities, and we will refer to these as passive investment activities, that do not fall within the definition of trade. And examples of these include investments that produce interest, investments that produce annuities, investments that produce either local or foreign dividends, pensions, those types of things. It's passive, so there's no trade attached to it. Something to be mindful of, however, generally we say that if you earn interest income, then you are not conducting a trade. The exception for this, of course, is money lenders. Now, a money lender is like a bank, a financial institution, where their entire business is built on loaning people money, or having people borrow from them, and then they charge them interest. So money lenders definitely, when they earn interest, they are busy conducting a trade. We have what we call Practice Note 31. And Practice Note 31 gives us the exception where interest that is incurred will be allowed as a deduction against any interest that has been received or accrued for a person other than a money lender. And if you take a look in the textbook, you'll see that the interest will be allowed as a deduction for these, the interest that you earn or the interest that you incur if you are not a money lender, but it's limited to the amount of interest income that you receive. In other words, if you are not a money lender and you want to claim interest incurred against interest earned, you are going to be able to, or you will be limited to zero. You won't be able to create a loss. When you look at the content for trade, you'll see there's a load of things we need to be mindful of. Things like, should there be a profit motive? What happens if you carry on more than one trade? What exactly is meant with a venture? Those types of things. So let's take a look at each of those individually. So what happens if you have more than one trade? If a taxpayer, whether it is a natural person, a company, if there's more than one trade, so several businesses, more than one venture that is being calculated or carried on, what we will do is we will calculate the taxable income or loss for each trade individually. So we will, basically what it means is we will group together all the income from that particular trade, and we will claim against that particular income all the deductions from that particular trade, and then at the end we'll add all of them together. You'll see what I mean with this a bit later in the year when we actually start looking at businesses with more than one trade. Important, if you look at the definition of trade, is that venture is specifically included. Now, sometimes you might be wondering, okay, but what is a venture? And A venture, if you look at the description in the dictionary, which means we're doing a literal interpretation, is risking something with the objective of making a profit. And, sometimes if you're busy with a venture, there might be no continuity, it's a once-off type of thing. But a lack of continuity, and if you look at the principle in the Burgess court case, you'll also see this, but lack of continuity or a once-off activity does not mean that a trade is not carried on. Something that people always think about as well is, but listen, should there be profit? So, am I conducting a trade if I don't make any profits? And the answer is no, there doesn't need to be a profit, but there should at least be the hope to make a profit or the expectation of profit. However, and again, each scenario will have to be judged according to its own particular facts and circumstances, but the lack of a profit motive or the lack of risk in the case of a venture, for example, does not mean that a trade is not carried on. At the end of the day, remember, in terms of Section 102 of the Tax Administration Act, the burden of proof lies on the taxpayer. So if you want to be able to claim a deduction in terms of the general deduction formula, you will have to be able to prove that you are in fact carrying on a trade.